Hey, folks. Happy Tuesday, April 29th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast and rainy Redmond, Washington. We're back to normal weather here in the Seattle area, and I hope that you are doing well and hanging in there wherever you're at. Market conditions overall drifting higher yet again today. Yesterday on the show, we talked about the improvement going into the end of the trading session today. Kind of a nice upside continuation to that move. Not a big movement day though, and I would say most investors in the markets as a whole sort of waiting with bated breath for Magnificent Seven earnings set to kick off tomorrow with Microsoft and Meta. And that's before a couple more report on Thursday. Plenty of earnings to talk about, though. Names like Visa, Starbucks, Booking, Royal Caribbean. We'll also talk about some of the charts like Tesla, sort of in wait and see mode. And we'll talk about some of the key levels and patterns we're watching for here as we progress to the end of April. With that in mind, let's get to the market recap and see how things played out. As I mentioned, kind of a choppy session. The end of the day, usually going into big earnings tomorrow, and obviously plenty of names reporting earnings, but some big market-moving names like Meta and Microsoft usually expect kind of lighter volume, sort of drifting higher, wait and see mode, and that's essentially what we got today. The S&P pushing further above 5,500, though, finishing the day at 5,560 and change. That's up about 0.6% from Monday's close. The NASDAQ composite almost identical at 0.6%. The Dow up a little bit more, about 0.8%. Mid caps and small caps all right around the same. So this is a fairly homogeneous day of the market drifting higher. The VIX continuing to move lower, almost a full VIX point to the downside. We're down to 24. We're getting very, very close to that 20 level. And a VIX below 20, by my calculations, a low volatility environment. That's where conditions are overall fairly stable. It's hard to imagine that we're getting to that point after the volatility we've experienced through the course of April, but here we are. So the VIX drifting lower, probably one of the more encouraging things you could look for right now, suggesting lower volatility, lower panic, lower fear, and as a result, probably lower likelihood, or at least the market pricing in less likelihood of huge swings to the downside and, of course, to the upside as well. So lower volatility, the MOVE index, which is like the VIX for the bond markets, also kind of drifting lower through the course of the last week or two. Looking at the bond markets, you can see the bond prices moving higher today. The TLT followed through on yesterday's rally, pushing up another 0.8%. So we've seen stocks and bonds rallying together this week, which is a bit of a different feel than what we've gotten in recent weeks. Rates generally moving lower. The 10-year yield's around 4.17, long bond yield around 4.65, 5-year yield below 3.8%. So we've seen yields drifting lower. We've seen bond prices drifting higher. And again, stocks and bonds kind of moving together. The dollar index slightly higher, about 0.33%. For the UUP. I had a great question from one of my market misbehavior premium members that I was responding to this morning, first thing, about the dynamic yield curve. So if we can digress for a moment, I'll look at the dynamic yield curve. The dynamic yield curve is a tool on the Stock Charts platform. And it's a really simple but super fantastic visualization, basically showing you the relationship between stocks and bonds, or more in specific, the relationship between the shape of the yield curve, which is what you see on the left, and the S&P 500, which is on the right. And this is meant that you can, click on the S&P and it's going back through weekly data. So you're quickly getting back into 2003, 2022, and you can see on the little preview chart where we're at. And the whole point is to look at the shape of the yield curve here. Now, I'll take you back to the late 90s, right? In the late 90s, we have what's called a normal shaped yield curve, where the longer end is higher than the shorter end. And that generally suggests optimism, right, for economic growth, because, for further down the road, we have higher rates assigned to that debt. As we continue on, we can see what's called an inverted yield curve right around in mid-2000. This is when I was just getting started as a new customer service rep, essentially, at Bloomberg, where I learned all about the markets. And the moment I learned about technical analysis, I was pretty much hooked. But that's another story for another time. Here we can see the inverted yield curve, which happens soon before a recession and before a big drop in prices. You can see when the yield curve finally became more normal shaped, which was like here in late 2000. That was while the market continued lower, well over a year plus, before eventually making a low in 2002. You can see the same thing going into the great financial crisis, this flat to inverted yield curve right around here, right? Sort of 2006 into 2007, where short-term interest rates are higher than long-term interest rates. We then get a more normal shaped yield curve as the market starts to go down. This is where the Fed is usually bringing short-term rates lower to try to spur economic growth or stir spending, etc. And so that normal shaped yield curve usually comes during the downtrend. Fast forward to where we're at to now, and you can see why investors were reasonably concerned, myself included, when we have a big, shiny, inverted yield curve in mid 2024 going into what looks like a pretty major peak. So the fact that the yield curve is taking on a more normal shape, while people have said, oh, is that good news for stocks? I mean, eventually it might be, but the problem is before major peaks, before recessions, you often have that inverted yield curve because that implies sort of pessimism about future economic growth, or at least the market pricing in a period of slower growth. The normal shaped yield curve usually comes during the recession as we're trying to spur growth down the road. And so eventually the market bottoms out. And so again, if you ask me why I'm skeptical that we've experienced the entirety of this bear market phase here in 2025, I would say the inverted yield curve usually means a lot more negativity in terms of recessionary forces, in terms of the market eventually going lower. And the market will recover before the economic data starts to improve. But that's sort of the situation you have right now with the yield curve. So for now, rates kind of coming down a little bit. And what that's doing is it's kind of reflattening that yield curve. So it's remaining relatively stable. It's technically normal shape, but depending on how you look at it, a little bit different. So we'll see what happens here. But that's what the yield curve is telling me right about now. All right, looking at some other asset classes, you can see gold and silver drifting lower. Again, a great conversation last week on the podcast with Jeff Huge of JWH Investments. We talked a lot about precious metals, a lot about the S&P and some other things as well, but a really good discussion about gold and silver. Today, drifting lower, the GLD down about 1%, the SLV, which is the silver ETF that we track, down about 1.2%. The big movement, though, in the commodity space was crude oil prices, with the USO down about 3% today. Energy ended up being the worst performing sector out of the 11, and weaker oil prices. One of the biggest movements on a day of relatively low volatility, big downside move in crude oil kind of stands out for me. Looking at cryptocurrencies, you can see Bitcoin pretty choppy there on the chart on the left. We've sort of been trading around 94,000 and 95,500 on the upside and the downside. Bitcoin currently trading right almost exactly at 95,000 as we go live with the show today. Ethereum price is up a little more. Ether back above 1,800, which is encouraging, up about 0.5%. You can see mixed results in crypto land overall. All right, let's look at the 11 S&P sectors. Pretty decent day in terms of sector breadth. 10 out of the 11 S&P sectors were up. Besides energy, down about 1/3%. Everything else was in the green to varying degrees, but no big, huge winners, right? I mean, a lot of days here recently, we've seen big swings, and that's what the elevated VIX kind of implies, right? That you'll have big multiple percent swings to the upside and downside. Today, kind of a calmer day, which makes sense. I feel like the sort of the calm before the storm going into earnings tomorrow from some of the leading growth names. With that in mind, financials are top performer. A couple earnings to focus on there. Visa is a chart we showed yesterday. We'll update you on the chart today as well there. One of the payment processors, PayPal, also reporting this week. So the XLF was up about 1%. Consumer staples, materials, real estate, basically all tied for second place, up just over 0.8%. After energy was down, that's the worst performer, just down about 1/3%, not too bad. You had technology and healthcare both up about 0.5%. All right, looking down here at the breadth, kind of not bad here, to be honest with you. You'll note that, it wasn't a big day, right? So very few names had big swings to the upside or downside, but on average, the stocks in the S&P, in the New York Composite Index, even mid caps and small caps, more likely up than down. We can see that the S&P 500 breadth almost a 3-to-1 ratio of stocks higher versus lower. The New York Composite Index, which is a broader universe, about a 2-to-1 ratio. So 65% up, 33% down. So worst breadth was in the NASDAQ Composite. Still 55% of that index finished higher today. So generally, I mean, pretty decent day breadth-wise. I would say breadth conditions continuing to improve. I did grab one of my breadth charts to sort of walk through key breadth indicators. Overall, not bad, right? And really improving in the month of April. When I think about what we've learned in April, besides the S&P bouncing off of what appears to be a pretty significant low in early April to where we're at today, back above 5,500, it's the improvement in breadth, right? The breadth conditions were quite negative going into the beginning of this month, coming out of this month in a much better position. In some cases, arguably getting a little overheated in the short term. We highlighted the bullish percent index on the NASDAQ 100, which remains above 70. As of today's session. So remains to be seen, but overall, encouraging breadth is an encouraging sign. All right, let's look at the Magnificent Seven and Friends, kind of the leading growth stocks. You can see Tesla up 2.2%, still failing to break out of that range, though really close to doing so, kind of at the upper end of where we've been the last 6 to 8 weeks, but not quite up there. I did write an article on stock charts earlier this afternoon, looking at Tesla and applying that stoplight technique, which we've highlighted before randomly, applying that to Tesla. So make sure you read that on stock charts. That's a free article on the website. Netflix up about 1.4%. That's encouraging because that's continuing to press new all-time highs. That's the only one of this basket of stocks, at new all-time highs this week. Meta up 0.9%. That's going into earnings tomorrow. Same with Microsoft, up about 0.75% going into tomorrow's earnings. On the downside, a couple of these names were lower. Broadcom, not by much, down 0.7%. Alphabet, Amazon, down slightly. Not a big movement day. And so you kind of have that expected sort of normal behavior going into a big earnings day, kind of quiet, calm before the storm type of activity. By the way, I do see some comments and questions coming in on the different platforms upon which we're streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you guys so much tuning in live. Those that are, anytime during the broadcast, pop a question in whatever comment section on the platform you're watching. I can see those all real time. I'll take a question or two at the end before we wrap the broadcast. Anything we don't get to, we'll put it in the mailbag. We've had some really cool all mailbag episodes. On Friday, we talked about the Zweig breadth thrust, which did fire at the end of last week by my calculation, although there's some debate on that. We addressed that on the show, and also some other great questions about different technical indicators, some macro themes, and much more. So thanks for putting questions in during the episode. All right, let's look at the heat map here. I mean, kind of a quiet day, right? I mean, if you look, the average color, similar to yesterday, right? Average color kind of neutral. And then you've got some things that were up a bit, some things that were down a bit, but generally netting out to a sideways move. So not a ton of takeaways looking at the market carpet today. I would say this is a generally quiet day. Energy stands out as kind of a negative outlier. We can see the average color there a little more on the reddish side than green. So crude oil prices, again, kind of rolling over here in the last week or two. That's putting some pressure on some of these oil companies. Really good interview, by the way, last week? I think it was on the podcast talking about energy stocks. Really, really interesting discussion about energy infrastructure and pipeline companies and sort of other things other than oil producers and integrated oil companies. That was actually a really good one. That was last week on the podcast. That was with Rob Thummel of Tortoise Capital. Other things that stand out, consumer staples, not a bad day. I mean, this wasn't the top performing sector. It was kind of mid-range right now. But in this kind of environment where there's been a big run off of the April lows, where you're looking to see if there's going to be enough upside momentum to carry us above what I would argue is a pretty significant resistance area we're kind of approaching on the S&P and the NASDAQ. I'm always casting a wary eye on the defensive sectors like consumer staples, utilities, real estate, to see if you notice some improvement there, because that would be a really negative sign right about now. If you're looking for, if you're all bulled up and you like what you're seeing with the major averages and the breadth, I don't blame you. What I would say is, as always, if you're bullish, look for signs to be bearish. If you're bearish, look for signs to be bullish. Look for the market giving you signs that whatever you're thinking is wrong, that your thesis is no longer valid. So for me, if I'm bullish here, defensive sectors improving right now would indicate that earnings are starting to worry institutions. They're getting to more defensive positionings. I'm not really seeing that necessarily yet. I mean, the trend in April has been away from value and away from defensives into growth going into earnings this week. Let's see if that's still the vibe at the end of this week after the next couple of days. But for now, I'm watching just to see if you get defensive sectors getting a bit of an improvement yet. Not yet. All right, in the upper left, technology kind of mixed, right? I mean, kind of quiet on the big names. No names moving a ton. You do see some names like Cadence up over 5%, Palo Alto, Synopsys, Arista with decent up days. But again, also a bunch of names down like On Semiconductor, SMCI getting dinged a bit. I think I missed that one. I mean, not a ton, right? 3.4% is kind of a normal day with a volatile name like SMCI, but rolling over after a bit of a rally here for the last week. Last thing I would say was in the lower left corner here, the financial sector. And again, I'm noting names like SPGI, that's an earnings name this week, up about 2.6%, continuing to rally off the early April low. Wells Fargo looks a lot like the chart of Visa. These are names that arguably are having kind of a bull flag pattern. I did not grab the chart of WFC, but I did grab the chart of Visa. Very similar chart, so I think the take is kind of similar. Financial sector is one of those that we talked about as being a really compelling area in 2025, and part of that is a yield curve play, right? As the yield curve becomes more normal shaped, which seems like the trend we'll probably be seeing. Certainly, if the Fed lowers rates here, probably not at this next meeting. The market's basically pricing in no change, but in the June and following meetings, pricing in a reduction in rates, probably is a nice boon for financial companies, for banks in particular. So we'll see. That's another area I'd continue to monitor for sure. It's kind of where I'm at. I mean, again, kind of a quiet, choppy day. Some things on the move, but not on average. I mean, the big names sort of quiet as we brace for earnings. By the way, someone mentioned the Money Show. I saw that in the chat a little bit earlier. As a reminder, I will be doing a presentation tomorrow. It's the virtual expo today and tomorrow. So if you miss out, it is a free event. You can sign up at marketmisbehavior.com/money show. That's a URL that'll just take you to the Money Show website to sign up for that free event. I'll be speaking tomorrow, and I should have put the time on there. Let me check real quick here. I'm speaking at 10 a.m. Pacific time. So that's 1 p.m. Eastern. And I'll be doing a presentation called 5 Key Lessons Learned Over 5 Years Interviewing Market Experts. I basically boiled down a lot of the cool conversations I've had on my podcast, on my shows on Stock Charts TV, and other interviews and panels that I've moderated. And I'll share with you some of the key kind of lessons learned, sort of investing wisdom from some of those different people. So again, sign up for that free event at marketmisbehavior.com/money show. Again, I'll be presenting at 1 p.m. Eastern, 10 a.m. Pacific tomorrow. Hope you can join me there. A lot of other presentations as well. I hope you enjoy those too. Not going to the Miami Money Show in person though. Couldn't work it out with travel. I will be going to a Money Show event later in the year. I forget when that is, maybe late summer, fall down in Las Vegas, if I remember right. But that's way down the list of things I'm worried about. So let's continue looking at the charts here. So here's the daily chart of the S&P 500. Again, on the surface, pretty bullish here, right? Over the last couple of weeks, we're seeing an improvement in price action. And whether or not you think tariffs are the best thing or the worst thing to happen in the history of the planet, the market is telling you things. There's reason to be encouraged. We're seeing the S&P break above trendline resistance. The chart of the S&P looks a lot like the chart of Visa and Wells Fargo. I'll show you the chart of Visa in a little bit. Kind of this downtrend channel, upper boundary can be formed using a trend line, and we've broken above that in the last week. We've also broken back above 5,500. That was an important level we talked about in March and then in early April. And so recovering back to that point, I think, is pretty important. So I think at this point for me, I'm finding, I'm less bearish, right? So I mean, just back here, I'm pretty negative about the general tendency, and I'm thinking any rally is sold. At this point, between 5,500 and 5,750 to 5,800, kind of in this range, I think that's more neutral, right? I think that's a yellow light on the stoplight. I think that's enough of a rally that you can start to believe in things. There are certain stocks that are actually looking quite good. My market trend model is still bearish, which tells me to still just sort of tap the brakes on being too aggressive here. But overall, I'm not seeing a lot of reasons to be specifically negative. I think we go back below 5,500, that very quickly gets negative right again. So I'll let you know. But for now, I think we're more in a neutral footing. I think the S&P above 5750, above the 200-day moving average, I think that's pretty significant. At that point, I don't think you can be bearish and be intellectually honest about the chart, right? Because at that point, we've broken through all those resistance levels that should be holding. If this is a bear market, we break above 5750, we push above the 200-day. I think you have to be long and strong and expecting further upside. Whether or not you agree with that being the direction, the market does not care what we think, as we've seen so often. Now, as we have this rally in the S&P, are there reasons to not be bullish here? 100%, and I'll list them out for you. The volume's not been particularly good, and even on weeks like this, it's lighter volume. The unbalanced volume is a good way to look at that. I prefer the Chaikin money flow, which we've showed on the show here over the last a number of times in the last week. Volume's not been super overwhelmingly positive. So you have a rally, but with plenty of distribution along the way. The momentum is not that bullish yet, right? So the RSI is just peaking above 50, but we're still kind of in the distribution range for RSI. So, as much as we've rallied off of the April low, which you have to remember is we're still recovering after a significant immediate sell-off, right? So we're still sort of chipping away, regaining some of that. And so I would say a lot of the evidence is not overwhelmingly bullish just yet. Weaker volume, weaker momentum are two things that immediately stand out to me. Final thing I would be is a lack of follow-through. Besides Netflix, with a pretty decent chart, I would say a strong chart at this point, hands down in any environment. The average Magnificent 7 stock is not a great chart yet, right? NVIDIA is not great yet. Tesla is not great. Meta's not great. These are all stocks that have failed to get above recent highs. And so I think until and unless you get that leadership, and maybe that's what we learn over the next 2 sessions with a bunch of earnings and investors being pretty happy. The alternative scenario, though, is the next big leg down starts with earnings being underwhelming. We've had some disappointing earnings here. We've had stocks not rally a ton on earnings, like Royal Caribbean, pretty decent earnings report, and the stock's not really doing a whole lot. So let's see. But I would say, again, we're trading up to some key resistance levels. To get meaningfully higher, you need catalysts to move up. So again, maybe a big tariffs are going away kind of announcement. I would expect the market to rally significantly, but again, I don't know if that's something I would think is decent to price into the market today. Now, here's some of the evidence that's sort of showing you the improvement that we've observed so far in April. There's the S&P 500 on a closing basis. Again, in the month of April, making a bit of a pattern of higher highs and higher lows. We can see the advanced decline line no longer breaking down, starting to improve. Again, not making new highs, but not going down anymore, right? So that's why I say it's more of a neutral read on some of these charts. The percent of stocks above their 50-day is up from less than 10% at the April low to up to 40%. So that's good, right? 4 out of 10 S&P stocks have regained their 50-day. The problem is that also means 60% of the S&P are still below their 50-day, as the S&P and the NASDAQ are trading up to downward sloping 50-day moving averages. So, basic trend assessment tells me that's still a downtrend, right? And it's a volatile downtrend, which means aggressive move down and aggressive move up, but it is still a downtrend, right? When you analyze the charts with that sort of technical approach. Now, the bullish percent index for the NASDAQ 100 did get above 70. The S&P's bullish percent index is very close to getting above 70 as well. That usually is where big moves higher tend to run into some problems. So I'm very keenly noting the fact that those point and figure based breadth indicators are getting up to sort of a danger zone. Maybe that's the sign as we're testing resistance with those indicators getting to an upside threshold, maybe an issue. Offense over defense, certainly starting to favor offense a little bit here in the last week. The trend has been down from mid-February now to through the month of April. So I would say, again, still kind of neutral. We'll see if that's enough to rotate that ratio higher. But certainly in the last week or so, consumer discretionary, things you want, outperforming things you need, consumer staples. And again, that's one of the biggest warning signs I would be looking for. If you're looking for signs of distribution, volume on down days is one way to look at that. Defensive sector starting to improve, just indicating that investors are rotating away. from offensive bets. That's what I'd be looking for here. Still remains to be seen. All right, let's look at some individual stocks here, some earnings names, some other charts of interest, and I'll take a question or two before we wrap. All right, looking at the chart of Tesla again, I wrote an article on stockcharts.com. I'd encourage you to check that out. That's in the free portion of the website. Basically applied a stoplight technique. So above 290, pretty strong chart. That clears the 200-day, that clears the March swing high, and this beautiful shooting star candle you can see there. We break below 220. That's a big distribution signal, right? And breaking to a new swing low. Between 220 and 290, which is where we've been for the last 6 weeks, it's neutral. And so I continue to see this as a neutral chart until and unless we can power above resistance at the 200-day moving average. Now we're right there. The RSI is exactly at 60, according to stock charts at the end of today's session. So we're trading right up to that point. We're at that sort of that key moment. Is there enough momentum to push above? And if we get a break above 290 on stronger momentum, I think Tesla looks like a fantastic chart after quite some time of looking like a not so fantastic or not so magnificent chart, as it were. Now, what you'll note on that chart of Tesla, which is range bound and testing resistance, exact same thesis for Microsoft, which is testing resistance at 395. As of today's close, we got right up to the mid-April swing high and the late March swing high. I think Microsoft above 395 is a pretty decent chart. I think Microsoft above 415, which would clear the 200-day, is a great chart. We're not there yet, right? First things first, we have to get above that point. But again, we're facing resistance as the RSI hits 60. That's kind of a supply area. It's kind of where you'd expect resistance, kind of where you'd expect a bit of a pullback here. And I'm concerned that that's happening going into an earnings release. If you think that's a concerning setup, what about Meta, right? Going into earnings, we've bounced off of 480, bounced off of support. That's good. We've now hit 580, which is basically testing this distribution pattern in early April. It's also testing the 200-day moving average. So again, Meta above 595, clearing the 200-day. That's pretty bullish. Until then, though, this is at best a sideways trend. So some of these leading charts, leading growth names, Tesla, Microsoft, Meta, two of those reporting earnings tomorrow. I would say at this point, their charts are at best neutral. Breaking above those resistance level becomes a pretty compelling chart, but that's a big ask after the rally that we've seen here in the last week or two. So we shall see. All right, some other companies have reported earnings. Coke is one that we've highlighted. Coke versus Pepsi, the cola wars in 2025. Coke has been a much stronger chart than Pepsi. We highlighted that on one of the shows last week, if I remember right. Coke's setting up what you could call kind of a cup and handle type of pattern. It's not a perfect one because it's kind of like a cup and a couple handles. It's a cup and handles, which is not technically a pattern. So not the perfect setup, but interesting, right? I mean, the idea with a cup and handle pattern is you have this very clearly defined resistance level, right? Kind of look at 73 to 74. That's the resistance from September of last year. That's where we hit in March, again in early April, and now in mid-April. And that broad bottoming pattern and then a shallower pullback, which creates the handle. A break above 74, clearing that range would be a very bullish setup. It's right about there. The concern right now is a bearish divergence, right? So these higher highs in March and April have been marked by weaker momentum. So that tells me to be a little bit skeptical. However, a break above 74 would right all those wrongs. It could be a really compelling breakout opportunity there. UPS is another earnings name. I mean, this is not a good chart. That is the official medical opinion on this one. As a technical analyst, this is a stock trending below two downward sloping moving averages. We've had a bunch of tests of the 200-day moving average, and every one of those has failed in the last 18 months. So this is the type of chart I would not be looking at until there's a dramatic improvement, signs of accumulation. If you think something's oversold and you think something could bounce, for me, that's more of a trade than an investment. Trading a move up to a declining 50-day moving average. I don't blame you for taking that kind of shot. I get that one. Is that more of an investment, betting on a long-term recovery? Absolutely not, from a technical perspective, right? I mean, this is the kind of thing that you're looking for an upside improvement. I did see that, by the way, Bull Bear Jeff, the UPS announced 20,000 layoffs. It's not. I looked in a little bit, and again, I need to study a little bit further. And thanks for mentioning that. It's not a tariff thing. It's not saying, we need to cut it. That's part of an expected reduction related to Amazon, who's relying less on UPS. So it's more of a glide path of removing or lightening that up. And that's still 20,000 drivers is still, a small percentage relative to the number of UPS drivers cruising around the world right about now. Having said that, worth looking at. And again, it would be better if they were adding drivers, right? In any scenario, I think that would be better for the company for sure. But yeah, that's not a good sign. Going back in the day, I was taught by a mentor, look at UPS and FedEx. Now this is, a different world in a lot of ways, but the idea was look at shipping companies, right? Because if people want stuff, they want stuff shipped, and UPS is going to do well in that environment. A steady decline in UPS is not a great sign for the broader markets. And for now, from a technical perspective, that's kind of what I'm seeing here. Booking.com is part of that travel and tourism trade. These stocks have all pulled back along with others here in 2025 so far. But I'm looking at BKNG, and we'll look at Royal Caribbean here in a minute. Actually improving. And what's great about the chart of Booking is actually featuring a bullish momentum divergence, which is not a pattern we've seen a lot of in 2025. Look at the lower lows in March and April, the higher lows in RSI. That's why we like to feature that pattern, because it often works pretty well. We've now gapped above the 50-day moving average and followed through. This is what we call a gap and run pattern, right? When stocks gap higher and then fail, that's a signal that we have revalued the stock higher, but everyone's cashing out. Here we have a gap and run where we're gapping, and then there's more demand coming in. People willing to pay even more and more for the stock. That's an encouraging sign. I think we're now setting up for a retest of 5,200, which would be the previous all-time high. So relative strength breaking out as well. Here's Royal Caribbean. Not as great, and again, kind of opened higher today, but closed lower. If there's a concern to think about, this was Royal Caribbean was pretty decent earnings report from my initial glance at it. Sort of reported more optimism than you'd expect, and the stock opened higher, but then traded basically back down to be flat for the day. When stocks have good earnings and don't break out, that's not a good sign. It basically just tells you people aren't looking to add risk right now. They're sort of tentatively waiting. Visa is another one of those financial companies actually rotating higher a little bit here. You can see Visa getting back above the 50-day moving average on today's earnings report, drawing a trend line from those recent highs. That trend line now being broken with the move above the 50-day moving average. Would love to see stronger momentum. That's a problem I have with a lot of these charts, because the distribution was still so strong in the month of April. It's taking quite a bit for the RSI to improve enough, and that's because it's looking at the average up day versus the average down day. And just the average down days were really down a lot in April. So it's taking quite a bit of upside momentum to sort of negate those distribution days. But certainly a chart to watch here. All right, finishing off, last chart, Starbucks. We featured this on the show yesterday. Earnings today, you can see we closed higher about 1.1%. Maybe barely getting out of this pennant pattern. Not enough though, right? Not like a resounding big breakout day, sort of a whimpering into the close kind of day. So we'll see if we're able to push higher. But for now, Starbucks, again, the momentum overall has been pretty weak. This is not my favorite chart out there anyways, but I would say a break out of this pennant pattern to the upside could be very encouraging, as we're basically testing the lows from the summer of last year. We'll see what happens. All right. Let's see. Yeah, Josh, thanks for watching on YouTube. Your comments, so many companies saying no guidance. And I think that's, again, if you take a step back, general takeaways that we're seeing in earnings season. I'm making a note to reach out to one of my earnings guys. You have to have an earnings guy. And I'm going to reach out, see if I can get him on the podcast here to sort of debrief at the end of earnings season. Nick Raish is his name, from Earnings Scout, based in the Cleveland area. And, again, my initial takeaway is just sort of taking a step back, taking a deep breath, and reflecting on what we're learning. Companies generally are having pretty good quarters, right? Royal Caribbean's a good example. Like we're beating estimates for the quarter, but forward-looking guidance is often being sort of removed, right? Sort of taking away the guidance and saying it's no longer reflects what we're seeing or what we're expecting. So we have to kind of adjust that, or at least they're just taking it away. That doesn't feel great, right? I mean, companies are having to remove forward-looking guidance. That usually means you're not, expecting to upgrade that. That usually means you want to downgrade it, but don't feel comfortable doing it. So I think that's an issue. It's less about what's happening in this quarter and more about expectations going forward. I think that's going to be key with earnings over the next 48 hours with the big mega cap growth stocks for sure. Thanks for making that comment. I think that's an important takeaway. I think too many times the headlines and certainly investors focus on the quarter. This is one of those times where whether or not they beat the estimates for this quarter, probably less important as what we're learning or what we're hearing about forward-looking guidance. And that is not particularly great so far. Let's see. Jeremy, thanks for watching on YouTube. I don't see volume on a lot of Dave's charts. I wonder why that is. I mean, quite simply, volume is not my primary input. You have to prioritize, and I think there are so many things we can look at as a technical analyst, as a technically oriented investor. I have a checklist that I have in mind, and for me, price is what's most important. The trend in the price, moving averages would be number two. The shape and the inflection in the moving averages, what they tell us about the sort of smoothed out price behavior. Support and resistance levels, and looking at key, levels where you could expect buyers or sellers to take action. Down the road, you get to things like momentum and volume, which are ways of sort of validating what you're seeing in terms of price action. So I don't have volume on any of my charts as a default. I do look at Chaikin money flow. That's the volume-based indicator that I use. If you look on stock charts, they have a section called Chart School, and if you go there and look for Chaikin money flow, you can see more information on it. I've done some random videos on my YouTube channel and on my stock chart show talking about volume indicators, particularly Chaikin money flow. But that's what I use, if anything. It's just not the most important thing in my arsenal. You can't look at everything, so that's what I sort of focus on. Let's see, maybe one more question and then we're done. Bull Bear Jeff, thanks for the comment earlier, by the way. I appreciate it. Which charts had a way to indicate the slope of the moving averages as angles? It's a really good point. And actually, there is some interesting work along those lines outside the scope of the show, something I'll think about maybe for a webcast at some point. But there are tools based on the slope of the moving averages, based on rate of change, and that's actually the shape of the moving average is what I always talk about. That's pretty much what I'm looking for. Some of the scans that I run in stock charts are actually based on the slope of the moving average. Looking for rotation from downward sloping to upward sloping, looking for price above upward sloping moving averages. I think it's a really good way to think about it for sure. Hey, listen, guys, thank you so much for watching live, those of you that have done so. And if you're watching the replay on our YouTube channel, I appreciate you as well. Make sure you drop questions for our mailbag in the comments section below the episode. We'd love to feature one of your questions on our Friday mailbag episode. But for tonight, I will say happy Tuesday. Have a great evening. Hang in there with all the earnings. We'll be back with you tomorrow to update you on what we're seeing. But in the meantime, it's always a good time to own good charts. Have a good night.